Hello everyone, and welcome back to the channel where we dive deep into the fascinating world of hard-to-borrow stocks and potential short squeezes. Today, we're putting a specific company under the microscope, one that's flashing some truly eye-watering numbers on our hard-to-borrow screener, CLRO Inc., ticker symbol CLRO. This isn't just about theory. We're going to break down CLRO's specific situation, its incredible cost to borrow, and what it all means for traders. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's start by getting acquainted with CLRO Inc., or CLRO. This company operates in the technology and communication equipment sector, and is currently a microcap with a market capitalization of just $14 million. CLRO was incorporated way back in 1983 and is headquartered in Salt Lake City, Utah. Now, for the critical detail about its current state, CLRO Inc. does not have significant operations right now, though it was previously known for designing and marketing professional audio conferencing, microphone, and video collaboration solutions. Show CLRO chart. Looking at recent price action, it's been a tough ride. Today alone, CLRO is down -7.94%. Over the last 5 days, the stock has plummeted -41.87%, and in the last 30 days, it's down -25.43%. Volume is also extremely low, with only 50,900 shares traded today, a stark contrast to its 30-day average volume of 6,466,296 shares. That gives us a relative volume of 0x average, essentially meaning trading activity is currently minimal. What is cost to borrow and why it matters? So, what exactly is cost to borrow, and why do we obsess over it here? Simply put, cost to borrow, or CTB, is the annualized fee that short sellers must pay to borrow shares of a company they want to short. When a stock is hard to borrow, it means there is high demand from short sellers or a very limited supply of shares available to borrow, or often both. This scarcity drives up the borrowing fee. These fees are expressed as an annualized percentage, and yes, they can climb well over 100%. Imagine paying over 100% interest on a loan every year. That's what some short sellers face. A sky-high CTB is a flashing red light, indicating extreme pressure on short sellers, or a potential signal of very tight supply. Why this stock is hard to borrow right now. Now, let's talk about CLRO specifics, because the numbers here are truly extraordinary. Our screener flagged CLRO Inc. for one undeniable reason, an annualized cost to borrow fee of 702.5%. Highlight 702.5%. Yes, you heard that right, 702.5%. That is an exceptionally high fee, indicating an intense demand to short or an incredibly tight supply of shares to borrow. With an estimated float of only 0.7 million shares, the supply is indeed very limited. While we don't have data on CTB momentum or the exact shares currently available to borrow, that 702.5% fee speaks volumes. Our internal composite squeeze score for CLRO, which combines various factors like CTB, float, and momentum, sits at 45.3 out of 100. This means it's on our radar, but it's not a top-tier score across all metrics, despite the mind-boggling borrow cost. Squeeze mechanics explained. For those new to the concept, a short squeeze occurs when a stock's price starts to rise, forcing short sellers who had bet on the price going down to buy back shares to limit their losses or meet margin calls. This forced buying creates a rush, pushing the price even higher, which in turn triggers more short sellers to cover, creating a positive feedback loop. When a stock like CLRO has a 702.5% CTB, those fees act as a constant pressure cooker on short positions. If CLRO's price were to suddenly reverse its recent downtrend and start climbing, short sellers would face escalating losses on their short positions plus those astronomical daily borrowing fees. This dual pressure could force them to buy back their shares, potentially igniting a squeeze. However, it's crucial to understand that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have incredibly strong conviction in their thesis and are willing to pay a premium to maintain their short positions. Dilution risk check. One critical factor that can negate or severely limit a short squeeze is dilution. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This influx of new shares can provide much-needed liquidity for short sellers to cover their positions without significantly impacting the price. New shares also dilute the value of existing shares, making it harder for the price to move up. In the case of CLRO, our check for recent dilutive SEC filings such as SMINUS-1, SMINUS-3, or 424B forms found no such filings in the last 90 days. Furthermore, we found no recent reverse split for CLRO in our look-back window. This means that, for now, there isn't an obvious, immediate dilution event that could directly offset a squeeze thesis. Let's take a quick pause for a very important reminder. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, given CLRO's unique profile, what should you be watching for? The 702.5% cost to borrow and the tiny 0.7 million share float are the headline numbers. Given the no significant operation status and the recent sharp decline of over 41% in the last 5 days, combined with today's extremely low volume, it suggests either extreme disinterest or a situation where short sellers are firmly in control and not facing immediate pressure. To see a potential shift, you'd want to observe a significant sustained increase in trading volume, particularly on days when the stock's price is rising. Any indication of shrinking borrowable shares if that data ever became available or further increases in the already astronomical CTB could heighten the pressure on short positions. Given CLRO's composite squeeze score of 45.3, it highlights that while the CTB is extreme, other elements aren't screaming imminent squeeze just yet. Tier 1 Inc. CLRO presents an intriguing, albeit complex picture. Its sky-high 702.5% cost to borrow and tiny 0.7 million share float make it a standout on our hard-to-borrow screener. However, the lack of significant operations, the severe recent price decline, and today's extremely low trading volume add layers of complexity. While the borrow fees are punishing for shorts, their strong conviction has, so far, overcome that pressure, driving the price down significantly. As always, this analysis is purely for educational purposes to understand the mechanics of hard-to-borrow stocks. If you found this deep dive into CLRO situation helpful, please hit that like button, subscribe to the channel for more unique analyses like this, and leave a comment below with your thoughts or any questions you have. We love hearing from you. Thanks for watching, and we'll see you in the next video.